Hello, everybody. I'm Jerry Kronenberg, Director of Financial News here at Moomoo Technologies, Inc., and I'd like to welcome you to our latest webinar with the man, the legend, Stephen Sarge Guilfoyle. Now, Steve is our market commentator here at Moomoo. He is with you every market day at the Invest with Sarge account on our Moomoo community. We encourage you to check it out. He is an expert, a former New York Stock Exchange floor trader for Credit Suisse, a former staff economist at a number of places, and he is currently a columnist for TheStreet.com Pro. And yes, his nickname is Sarge because he was an actual U.S. military sergeant. Steve, welcome. Thanks for joining us.
Oh, thank you for the flattering introduction, and thank you for having me.
As always. Now, as everybody knows, earnings season is getting underway, but not everybody really understands what to look at and how to look at earnings and how they affect stock prices. So Steve is going to help us out. Now, whether you're a novice or an expert, I'm sure he's got some things that he can tell you about. And I'd like to encourage you to ask him your questions now in this live chat. This is an interactive chat. Submit a completed question and we will give you 100 Moo points as a reward. And if we use it during this broadcast, we get 1,000, 1,100 altogether. Heck of a deal. So send those questions in now. Now, Steve, while we wait for some questions to go, I've got a few to ask. Let's start with some basic things because not everyone is that advanced. When you're looking at a company quarterly earnings release, talk about some things that you look at. We hear revenues, earnings per share, things like that. What are some key things that people might want to look at?
Well, the very first things you look at, the headline is going to be the GAAP, generally accounted principles, earnings per share number, or the adjusted earnings per share number. And with some firms, the adjusted number is a little bit of a baloney, and with some firms, it's legit. But we look at the earnings per share number that's being accepted by Wall Street, more or less. We look at the revenue number to see if there's growth, to see if there's a lack of growth. Those are the headlines. Then we move on to things like fundamentals, and the press release, and we look at the conference. We listen to or read, if you don't get a chance to listen to it, the conference call, so you can get an idea what the chief financial officer, what the CEO are talking about, and what kinds of questions analysts, at least respected analysts, are asking them.
Right. Let's just take it back a moment and say, when we talk about the earnings release, that's a press release the company puts out. Usually it's going to be before or after the market. Usually you can know in advance when it's going to come up by looking at economic calendars or earnings calendars. And you can look at it at news sites, at the company investor relations site, and things of this nature, so you can get an idea of what to look at. Now, you said something very interesting. You talked about GAAP, or generally accepted accounting principles, and non-GAAP earnings or adjusted earnings. Let's talk about that. Why would you, so define what that means, GAAP and non-GAAP, and why would you ever look at non-GAAP or adjusted? Now, Wall Street does it all the time with certain companies. Why don't you talk a little bit about that?
Oh, yeah.
What's the difference? Mm-hmm.
All right, GAAP, EPS, earnings per share, is the actual earnings per share. That's the truth. Now, some firms have one-time items or things that aren't part of their normal operating expenses, and they exclude them from the number to show an adjusted number, which in their minds, and they want it to be in the minds of their investors, shows the relative wealth of the business away from these one-time or extra. I don't even know what word to explain how to explain it, but these expenses that are not part of their normal business's operating expenses. So they'll show you, they will report both, but you have to read into the press release to see both. The GAAP number is the money they actually made or lost. The other number is the number that they believe is how well their business performed away from the other expenses.
Got it. Excellent. Now, of course, we've all seen this too, that it's not just the earnings per share, but it's the earnings per share against what the analyst had forecast. So if a company earns 20 cents a share, the really important thing is, well, did the analyst expect 20 cents or 15 or 25 or what have you? Now, we've all seen this a lot. A company will miss the analyst estimates by a penny, or they'll beat it by a penny. 20 cents a share, the analyst expected 19, or the analyst expected 21 cents a share. Maybe they have 1 million shares or whatever. It's a relatively small amount of money. And then the stock rises or falls, 10%, 15% automatically. Millions of dollars, maybe even billions of dollars in market capitalization lost. What happens there? I mean, it's a small amount of money and has a huge impact. Why does that happen? And can you talk a little bit about that? What's going on there?
In that case, they're really probably investors and traders are not really reacting to the performance, but more reacting to the guidance. If the guidance was strong or weak, or if a certain sector within that company's businesses. Let's say this company has 4 business sectors, but one is really hot and really growing. Even if the other sectors, which are considered maybe less important right now, perform moderately well or not so well, but that one sector that they need to be hot really was hot, even if the overall performance of the company wasn't so great, the stock might still run because they're in artificial intelligence or whatever they're talking about at the time, whatever's hot in the market at the time, and that business is performing well or picking up new clients. A lot depends on the guidance. A lot depends on how the sectors within the business are doing, and a lot depends on really the questions in the call after the earnings are released. What kind of questions the really smart analysts are asking, and how the CEO or CFO feels those questions. Whether they sound confident, whether they sound a little shaky, whether they sound like they're making things up, or being a little too reliant on like a keyword that's hot at the moment, so the algorithms will pick up on what they're saying.
That's great, and we hope you'll join us in the future. Steve will be talking about how to listen to earnings calls. But raising that point, you raise an interesting point as well. We also see a company will have great earnings, and then the stock falls, or the converse, they'll have bad earnings and the stock rises. And let's talk a little bit about that in the forward guidance. Why does that happen? Some people are very surprised when that happens. Hey, they beat on earnings and the stock's down 10% or vice versa. What's going on there?
Well, the guidance is really, it's almost more important than the performance at this point, because it projects into the future. And if let's say they had a so-so quarter where they just barely met expectations, maybe they didn't quite meet expectations, but in the call, the CEO says business really picked up in the last 3 weeks of the quarter. We were able to get into within the range of our expectations for the past quarter. But because of how this business picked up, we're increasing guidance going forward. The stock will likely run on news like that, because they're telling you that the market has probably mispriced the stock, expecting a lesser guidance going forward, because the company may have given prior guidance, but now they're increasing their guidance. So even if the performance lagged a little bit, a stock may run because the CEO or the CFO projects a number higher for forward sales than we had previously expected.
Okay, great. So let's go to some questions, and let's start with some we got in advance of this broadcast. This is a 3-part question, but it's a good one. So part 1, what is deferred revenue balance on an earnings report? When we consider, and when we read an earnings report, do we consider the deferred revenue as a positive indicator of future revenue, even though it is reported as a liability? Give us some thoughts on that.
All right. Deferred revenue is a good thing. It's yes, it's listed as a liability, but I don't hold deferred revenue against the company at all. It's not an indication of future revenue, because that revenue is already in house. So it's basically a liability. It is a liability, but it's not a financial obligation. It's a liability of services or goods owed, because the client has already paid for them. So you're not going to make any more money from whatever trade deal you made with that client, and you do owe them if it's, if you owe them a product, or if you owe them services, software services, something like that, you still owe that, but you do not owe them money. So when figuring things on the balance sheet, let's say figuring current ratios or quick ratios, when you're figuring on the health of a balance sheet, I do not hold a large deferred revenue balance against the company at all. I actually look at it as a positive, because that shows the company's having a problem meeting up with its own demand.
Great, excellent. All right, part 2/3. Are there any derivative instruments such as options that can be used to hedge or amplify exposure to a stock's price movement during earnings reports? Now, options are kind of your bread and butter. While you can't give specific advice, why don't you talk a little bit about how they play into this?
Well, not during earnings reports, but going into and exiting earnings reports. Of course, yes, you can, because you can realize fantastic gains on an options trade as opposed to an equities trade, because the equities trade requires so much more capital. Yes, you can amplify. You can also amplify a loss if you're let's say you're selling those options and it goes against you. So you can end up with an equity position or a synthetic equity position that you really don't want. So yes, you can greatly enhance, or even in some cases greatly damage your prospects using options going into and out of an earnings report. As far as other derivatives go, I think you can get fancier with your options plays, but I would not play a stock's earnings with anything other than equity or options. I wouldn't. I mean, you might want to play a similar equity or option, something you think might move with or against it, so as sort of a hedge. But I think you really want to stick just the equity itself and related options when playing an individual stock's upcoming or earnings report.
Great. All right. Next question from Mr. Cash Cow. Kind of a similar question. How do we manage and minimize our risk exposure? Any thoughts on that?
Well, the easy way is to go to higher cash levels going into earnings. That's believe it or not, I do know solid performing traders who will they'll exit positions ahead of earnings and re-enter them after earnings because they've been hurt so many times. Even though it feels so great when you nail it, it hurts just as bad, even worse when you get nailed. So I do know traders who will go to higher cash levels in stocks that they intend to hold for a lengthy period of time, just around earnings time. Now, we already talked about options. Options is another way to hedge or manage your risk around a given name when that name is about to report. Just through simple spread trades, going short along a bull call spread or a barefoot spread, or getting really fancy and playing on or against volatility through straddles, strangles, condors, butterflies, iron condors, iron butterflies. It sounds like I'm rattling off a lot of stuff. I am, but you can look all these things up. They will make sense when you actually look it up and read through at Investopedia or something like that. You read through the page or two that they have on each one of these spreads, and by the end of reading it, if you really pay attention, you will understand it. But straddles and strangles are really easy ways to play on or against volatility, and they don't take as much thought as all the condors and butterflies.
Excellent. Great. Next question, again, somewhat options related, popular topic today. This is from Bellwether. Do you ever hold directional options contracts through earnings? If so, must they be dated a week or two past to profit and to avoid Ivy crush and theta decay? Now, again, Steve can't give his own personal portfolio or advice, but why don't you talk a little bit about those topics in general?
I'll tell you what, yes, there are times I will hold directional options plays post earnings release, but it's usually when I've been wrong. If I've been right and I have my profit that I was already targeting, I will take the money off the table. If I was wrong on my play, and let's say I paid $1 for the option and the option is now worth a couple of pennies, well, no, I won't sell it. I'm not going to sell it for a couple of pennies. I'd rather give it the few days, the half a week or the week and a half until it expires, and see if maybe that couple of pennies can turn into a dime or 15 cents, because I'd rather sell it for 10 or 15 cents than for nothing.
Okay, great. So again, your experience may be different for others. So Steve is not giving is just giving generalized advice, not personal advice. All right, let's go to some live questions here. This is a good one. When reading an earnings report, what are some indications that things may not be what they seem on the surface? Any thoughts on that one?
Sure. I actually printed something out in anticipation of a question like this. All right. When you go into the press release, now obviously you're not going to be able to see this on the screen, but just for show, there are 3 statements you need to understand. All right. There's the statement of operations or income. There is the statement of cash flows, and there is the balance sheet. All right. These 3 things, these 3 statements will or should tell you how the firm is doing in an overall sense. Now, you're going to have to go deeper into their material, their supplemental material, and go into the reconciliations too if they're reporting an adjusted earnings per share, because these statements are required by law. So these statements are the GAAP numbers. They may also print alongside it the adjusted numbers just for comparison's sake, or it may be at the very bottom of the press release as a reconciliation. So you're going to need to look at the reconciliation too if the company you're interested in is reporting adjusted earnings. But if something's GAAP, you're golden on these three sheets. And we can go into them. I don't know if this is for now. We can go into these in some detail if anybody just digs fundamental analysis. But I'll leave that up to Jerry, because I'm a nerd who likes to do fundamental analysis. I know most of you viewers probably are not.
Well, we hope you'll join us. Steve will be doing a whole live stream on fundamental analysis in a few weeks and in greater depth. But here's a good one. This is from Summer LD. And this is probably for a basic beginner, which we have many. What is the first thing to know about earnings reports? So let's take it back, Steve, when you first got started. If I don't know a lot about this, what am I looking at?
The first thing you want to know is what the consensus view of the analyst community is for the stock that you're interested in, and see how that measures up in terms of earnings per share and the revenue growth. Those are the two big headline numbers. Those are the ones you probably want to learn first. I have years and years and years of black marble notebooks where all I did was write down the stocks I was interested in, what they were expecting, whether they beat on earnings, whether they beat on revenue, and what the growth or not or contraction was in actual sales. And I mean, I have decades of those notebooks, and that's until I just did that until I got to a point where I could take it a little further and start understanding more. And you know, and there are certain people you can listen to in the media too that will talk about earnings calls and things like that. You want to make sure when you follow folks in the media that they're not, you know, the kind of blow smoke or talk. We all talk our own book, so I'm not going to tell you not to listen to people who talk their own book, but make sure they can speak to technical setups, fundamental analysis, and policy-driven economics, because those are the three things that are going to impact to a great degree the profitability of any corporation.
Great. For some of our less experienced investors, talk your own book means, right? You're an analyst. You have
talk your own book means if I'm on Fox Business later today or CNBC or one of those networks, and I am long XYZ stock, which is a fictitious stock, and I tell people how great XYZ stock is because one, you're not necessarily lying, because if you're long that stock, you do believe the story, but you may be emphatic about the story, maybe to a degree where you're unintentionally biased or maybe even intentionally biased. And so when I do get in a situation like that where I am talking about my own positions, I like to say on the air that I am right now talking my own book, just so that the viewer or listener understands that when they decide whether I sound biased or not.
All right, excellent. Next question. I love soya. I kind of like it myself. This is a good question. Are share prices reflected before earnings reports are officially released? So the day before the report comes out or an hour before, has it already been factored into the share price? What's your thinking on that?
I think the expectation is always priced in. Now, when you get a surprise, that's when stocks move. Sometimes you'll see the algorithm start to move before the actual release. Supposedly, nobody knows anything before they're released, but like anyone else, I have my doubts when I see the algorithms move ahead of the humans, and I believe that somebody might have heard something somewhere before they should have. But you can never really make those accusations without getting yourself into maybe a fight you don't want to be in. But yes, like this individual loves soya, sometimes we see those share prices move before they should be when something is released, and it does make you wonder.
Here's another one from user KK3913. All right. Is the ratio provided in a report being audited? What kind of ratio should we focus on so that we can avoid companies that are a danger to invest in? I'm not exactly sure what we mean by ratios, but just in general, are these numbers audited, and is there anything
I'm not
you
sure
look at that throws you off?
I'm not sure which ratio he's speaking to as the ratio, but when I look at the balance sheet, I'll look at the current and quick ratios. The current ratio is simply the firm's current assets divided by their current liabilities. Current in this case means assets or liabilities that are due within the year, less than 12 months out. Total assets, total liabilities would be forever assets and liabilities. So I like to look at the current ratio. You want to see a ratio. Rule of thumb is every firm is different, but rule of thumb is 1.0 or better. Means the firm can at least meet their short to medium term obligations. Now, quick ratio means you do the same calculation, but without inventories. You take inventories out, because if there were a crisis, it's almost a certainty that the firm, if it's a high inventory firm, would not be able to sell their inventory for the price they valued at. Let's say an auto manufacturer buys a ton of steel, and they have steel in inventory like crazy, and they paid a high price for it. But now that firm is having a liquidity crisis and needs to make sales fast, and they need somebody to take the steel off their hands. They're obviously not going to be able to sell it for what they paid for it. So the quick ratio takes inventories out of the game. If you can still maintain a 1.0 ratio after taking out inventories, that's considered to be a strength. Now, if we don't really hold retailers to the same standard as others with quick ratios, because retailers are so heavily dependent on inventories that it skews the result of the ratio. So we tend to stick more with current ratios for them, just because the business is so different from let's say, industrial firms.
Okay, great. Here's a three-part question. I'll give you two one at a time. From the Aaron, these are the Aaron. Question one, these are actually all excellent questions. Are there any other important metrics specific to the industry or company that investors should pay attention to, such as subscriber growth for a subscription-based business or same-store sales for a retail company? Obviously, it's going to depend on the stock, but beyond EPS and things like that, let's talk a little bit about what else you would look at or recommend people look at or suggest people look at for a certain specific type of stock.
Yeah, sure. Every industry has certain metrics that they look at specific to that industry. As he said, same store sales for retailers, subscription growth for maybe tech companies or software companies. I could think of efficiency ratios for railroads. I could think of medical loss ratios for health insurers, efficiency ratios, which is a different thing than it is in the railroads with the banks. So there's a number of other ratios that matter for the banks as well. So yes, there are really a plethora of ratios specific to industries that we can look at. And if you're in those, if you're trading those industries, you really should know what they are, whether higher or lower is better for those ratios, because it's different for every one of them. And you should really know how the company or two or three that you're trading in that industry measures up along the lines of those ratios to their direct competitors.
Okay, great. Part two, another good question, same person. Are there any risks or challenges highlighted in the earnings report that investors should be aware of, such as regulatory issues, supply chain disruptions, or changes in consumer behavior? What are your thoughts on that?
Well, they'll usually let you know in the call if there's been a change in consumer behavior. They'll either blame the consumer or they'll be grateful for the consumer, depending on how the results have gone. Regulatory issues, if they're not yet known, they're not going to be revealed in an earnings release. So they usually come upon a firm at a time when they least expect, or at least they publicly least expect it. Maybe they kind of knew it was coming, and it will be addressed in a separate press release at that time. And what they're doing about it, whether they're cooperating with the regulatory agency or whether they're disputing it and they're going to fight it with everything they have. They will usually let that know. But when you do have regulatory issues, it is usually a negative for the stock of a corporation. Except of late, we've seen with some of the behavior in Washington D.C. as far as mergers have gone. When the FCC, what is it, the I forget her name. The
FTC.
Secretary of the FTC.
Khan, I believe her name is.
The Secretary Khan has gone after so many corporations, so many mergers, and she's failed so spectacularly in making any of these things stick that a lot of people are starting to take her actions a lot less lightly. But normally, with a more successful head of that agency, it usually means trouble.
Okay, great. And last part of this user's question: does the earnings report provide insights into the company's long-term strategy and vision, and how the management plans to drive future growth and profitability? Is that where you see this, or on the call, or what do you look for toward that long-term strategy? How's it going? Things like that.
If the firm provides guidance, like during COVID, a lot of firms did not provide guidance, and some of them still don't. Like Apple still just to name a name, but I'm not in it. Apple still doesn't provide specific guidance, although they will guide general trajectory guidance. Guidance is something that most firms will provide in the call for sure. And many of them will also provide it in the press release. But a lot of firms will say where you would expect to see the guidance in the press release, it will say guidance will be, or outlook will be provided during the earnings call later today. Because that usually means, if some of them will release their guidance and it's 6 or 7 bullet points and it's easy as peasy to understand. Other firms, they want to explain it to you because there's a couple of circumstances that they want to make sure you're aware of when judging them on their guidance. So they'll make you wait for the call.
All right, great. Next question from Juan E.H. A little bit technical or specific, but let's see if you have any thoughts on this. How do we judge the depreciation and trade receivables amounts and whether that is suspicious in a financial report? Is that something you ever look at or have any thoughts on?
I mean, if it's in the balance sheet, I'll look at it. I'll glance at it. It's not one of the things I look at, when I do my initial analysis of the company. I don't find it suspicious unless I already have an inkling something suspicious is going on. So if I look at the balance sheet, let me get to my balance sheet that I printed out for you. What we want to look at under assets, under current assets, is cash equivalents, and marketable securities, because we want to know how liquid the firm is. And under current liabilities, I always look at deferred revenue. Somebody asked about that earlier. I look at deferred revenue because when doing my ratios, I will create for myself. It's not anything you see anywhere else. An adjusted current ratio where I take deferred revenue out because I don't think it should be held against the corporation. So I will look for that specifically and get rid of it. I look for current debt versus short-term debt. Let's say a firm has $5 million in cash and they got $6 million in short-term debt. Now that's a problem because interest rates are a lot higher now than interest rates were probably when they took this debt out. So if they have debt coming due this year and their cash balance is not enough to handle it, they're going to have to refinance this debt, most likely at a much higher interest rate than they took it out. So that's something I look at very seriously. And then I look at long-term debt and basically total liabilities in general to see how much space there is between liabilities and equity combined. Because as you know, assets in theory should equal liability plus equity. So those are the things I look at first and foremost. I will look to see for certain types of companies what kind of inventories they have, or what kind of plant, property, and that sort of thing. They have tangible assets, we'll call those. Those are more durable. Those are more permanent assets, not current assets. But I like to see how much infrastructure or tangible assets they have, because I believe that tangible value is worth more than goodwill and what's labeled simply as other intangibles. Okay, if most of your assets, if 40% or more of your total assets are intangible, unless you're some company with a tremendous amount of characters or a wonderful brand name that everyone thinks is fantastic, if you're some company that most of us have never heard of and 40% of your assets are intangible, then that is suspicious.
All right, that's good to know. All right, Stephen Guilfoyle, we're going to end it there. Thanks for everything. Thanks to everyone for watching. Now, if you have more questions for Steve or we didn't get to your question, check him out every day, every trading day on the Moo community. His handle is Invest with Sarge. He's here to help you out. Cannot give specific advice, but he's happy to answer questions on a variety of topics, explain them to you. Stephen Guilfoyle, thanks for watching. We're getting right to the opening bell as I'm speaking live. Everybody have a great trading day. And I appreciate everyone coming in today. I'm Jerry Kronenberg from Moomoo Technologies, Inc. Thanks for watching, everybody.